Okay, we're going to get started. It's 3 o'clock. My name is Daniel Medina. I'd like to welcome you to our Wednesday webinar. For those of you who don't know, I've been with Investors Advantage since 2006. The company was established by John in 1979, so we're passing 40 years now. We're going to start like we usually do on our website. If you haven't been here, make sure you check it out. We post all of John's interviews along with our webinars past and coming up. And some of these interviews have over 150,000 views now. We are part of a larger group called Elite Financial Network, manages about $800 million. One of the things that makes us unique from other advisors, particularly in the Canal Valley, is we pay for independent research. One of only 2 companies that we know that does that. And now here comes John.
Thanks, Daniel. Well, folks, thanks for joining us this afternoon. I hope you're as cool as you can possibly be, and I also hope you're awake and alive and attentive. I guess so far the state of California has missed these rolling blackouts, and this morning I was astonished to see there was 155 fires, mostly in Northern California. Now it's twice that. So we have to be vigilant. We've got to pay attention to what's going on here because things are changing in the blink of an eye. And we need to be on top of those things because some of them will change and turn around and make things really, really awful. So what we're going to do at this point, I've got 4 charts that I really want you to focus on, and we'll be sending these to you on Sunday as we normally do. So you'll look at them again. But sometimes it's that picture that gives you 1,000 words that really gives you a sense for having an understanding. So our topic today is, are we headed for a decade of depression? A decade of depression is the question. And a lot of people have problems with using words like budget and math and recession and depression. And let's understand, thanks to Dent Research, one of the companies, we paid up to $10,000 a year for independent objective research, where there is no tie to any product or manufactured vehicles like mutual funds or insurance or exchange traded funds. We find that the Great Depression won. On a per capita basis, more people became millionaires than at any other time in history. So what I'm really saying to you is some of these words are scary, but if we let the word or the fear take our breath away and get us out of the game, we don't see the opportunity that might be right behind that hurdle. It will hurt, and life has ups and downs and hurts that come with it. But to the extent that we are as agile as a palm tree in Hawaii when the winds blow, we'll probably be able to survive to the next wind. Whatever that wind might be called at that particular time, or if you like, the next hurricane, whatever the natural disaster might be called. But when we get stuck and we become complacent, that makes us, immobile, which means we're likely to break. We don't like that to happen. So for our way, we think part of our job is to help you see what we think may be around the corner. And let's see if we can prepare for that. So that's what the attorneys want us to say. And let me kind of put things in perspective. This is our agenda. We're getting through the introduction now. Are we headed for a decade of depression? We've got 4 slides we'll study together. And please feel free to do what you've been doing. Post these questions while we're on the air or on the same webinar at the same time. Send them to us afterwards. Give us a call. Give us your thoughts, because you're really directing the material that we come up with here. So last week, I was having a great conversation with a good friend of mine who ended up being student body president at my high school. And then he went off to a girls' college that for his year that he entered college, he was so delighted that the school had just changed the rules, allowing men to come to a women's college. So that was very exciting for him, and he graduated magna cum laude. Now, here's what he said that made me go, he's probably not alone. He said, my investments, by the way, seem to be booming. I only get statements quarterly, but the last quarter or so seems to have been prosperous. This is a direct quote. So I need to say to you exactly what I said to him. That's nice, but please do not be complacent. Please do not look at your statements just quarterly. In fact, I'm going to suggest that you go back to look at your statement from February 19th, which so far seems to be the high for the year of the market, and March 23rd, which seems to be the low for the year so far. By the way, I think that low is going to be tested. So as I said on countless TV interviews, enjoy the melt up as you simultaneously prepare for a meltdown. Do I know when it's coming? No. Does it matter? I don't think so if you're ready. And that's one of my lines. It's not about the prediction, folks. It's all about the preparation. If you're ready, you'll probably be able to tell the story. If you're not ready, well, maybe we have to talk about you because you're no longer here to talk about yourself. So let's go, my father was a poster, did all the furniture here. And one of his best lines was, let's get down to brass tacks, as the poster. That was very fitting. So as they say, look at the portfolio from that peak to the trough, because in many cases, it was more severe than most people recognize. And the real point here is, if we look at in some reports that we received, the loss from peak to trough, February 19, 20 to March 23rd, 20, was 34 to 37%. Now, if we round up, we'll get into this a little bit too, because one of the things that the industry, the securities industry, I've only been in it since 1979, so I reserve the right to apologize for some of our work, is we say that, stocks for the long haul, hold and hope, sit and take it. But here's the math. If your account's off 37%, we'll round up to 40. You need over a 60% gain to get back to even. Over 60%. So one of the questions that we think bears being asked is, what kind of loss can you live with? We'll get into that a little bit more too. But let me bring you up to date. So it looks like the Dow may have had its best 100 days since 1933, as of Friday, according to Barron's. And yet, when we look at, one of the things we're doing is giving you the report, you look at the news that says what it did today, and it makes you go, it's hard to see a pattern. Here's the pattern for the year. The market in many reports from March 23rd is up 50%. Wow, that's terrific. Who doesn't want to participate in that? Who wants to do fear of missing out? So let's put some money in there and get greedy and let's get rich, right? Real easy. But the Dow, our oldest index, is off 2.96. That's from January 1 through today. The Dow's off nearly 3% during a year, or certainly since March 23rd, a great year relative to how the market has responded. The market actually has been a V-shaped recovery. The overall economy has not been V-shaped. We'll talk about that too. The S&P is in positive territory, up 4.46%, again, from January 1 through today. And now the NASDAQ, that's the high flyer. The NASDAQ, that's primarily tech stock, is up over 24% for the year. So that's really a good gain. But here's what I'm saying. I mean, just to put it in perspective, we hope you've enjoyed your flight, ladies and gentlemen. And now it's time for you to put your trade table up and in the locked position, because just as the plane ride has been very nice, it might get a little bit higher, but let's suppose it goes a lot lower. I mean, I don't know what the odds are of it swinging either way. We could say 50% one way or the other. We'll all be just fine with the 50% gain, but none of us will be so good with a 50% loss. And that's the concern. This season, by the way, as we get through August, we get through what we call at our office, the bewitching season, not just because of Halloween, but because it seems like September and October, in fact, September since 1928 has solidly been the worst month ever, consistently. Now, only a loss of 1% historically, but just as so many things have been unprecedented, I'm not trying to suggest to you that there might be a meager loss. I am trying to suggest to you that the loss could be more severe than most of us imagine. And I am saying to you, let's be careful of what we pay attention to. Now, let's look at this second chart, please. And this is Warren Buffett, who said that in 2001, using this indicator should have been a very strong warning signal. That's a direct quote from Warren Buffett. And what he's showing you here is this gauge. Now, it has its flaws, like everything else does, in comparing current stock valuations to gross domestic product. That's all the spending of consumers, businesses, and governments in the country. And it doesn't, not all countries, this is a report for all countries, not all countries provide the most reliable data or regular GDP data. So, you've got to take that into account. At the same time, what you can see is the gauge takes the combined market capitalization of all the publicly traded stocks in the world and then divides that total by the global gross domestic product. Now, you may recall, this was fourth quarter. This was actually September of 2018 when the IMF declared at their annual convention that that winter is coming. So when people act like, they didn't see it coming, that's because we're typically not paying attention. What he's showing you here is as this, the red line is at the 100 mark, and we've been to this peak before, around 2007, 2008, and a reading of more than 100 suggests that the global stock market is overvalued relative to the world economy. This is per Markets Insider, and this is one of the things that we watch as well, and we're sharing it with you because we're saying to you, don't miss what's going on here. This thing could turn upside down very quickly, very viciously, and please keep this in mind. When the market is going up, it often takes the stairs. But when it's coming down, it takes the elevator. And now it may become a question of how low can we go? And we think that's the piece of the puzzle that most people have not wrestled with. How low can it go for you and you not go nuts? How low can it go and you feel like you're still in the game? Or think of it this way, what kind of loss can you live with and not go bat crazy, right? It's a fair question because maybe, just maybe, there could be a way where a portfolio could be designed in such a way that it might just perform within your specific personalized parameters so that if the market's off, whatever it might be off, but your portfolio is holding up relative to the number that you can live with as a loss, then you can stay in the game without a Hail Mary pass. That's the part that we get worried about. People who don't want to stay in the game or feel like they need to exit stage left because they're afraid the Hail Mary pass won't come in when it needs to. What we want to do is let's not play any game where we need a Hail Mary pass. Let's limit our losses if we can so that we can always know that we can get back in the game and enjoy life and have a nice day. Okay, so let's look at the next one. And here we did the math for you. Because as I say, the primary message the securities industry has delivered successfully is some version of buy and hold and hope, sit and take it. And the savvy investors we've had the pleasure with find those statements insulting. Sit and take it? Hold and hope? Buy and hold no matter what? The beauty is that there have been some improvements in every industry thanks to technology. And in the securities industry, starting about 1999, in fact, we were part of a beta test of a company out of the UK that had created a brokerage firm and a financial advisory money management firm where they were looking at what can we do to limit losses? How can we actively manage the portfolio so that we don't stay in shares, we move out of shares going to cash in a bad year, and then move back into risky assets in a good year. So it's like getting out of stocks and or bonds in 2008, systematically throughout the year as the market's going down, we move to cash. And then by March 9th, we see that the volatility has reversed itself. It's now upward volatility. So we can reverse this. Let's take the cash back down, put the portfolio back at 60, 70, 80, 100%, whatever the portfolio used to own, and enjoy all of those gains. And the evidence is that investors who took advantage of those kinds of strategies might have been off no more than 20% in 2008, which means they only needed a 25% return in 2009 net after expenses to get their account back to even. Some actually saw a 30% rise in 2009 after a less than 20% decline in 2008, which means those folks who saw that minimized loss and those kinds of gains, more money in a year or two than the rest of us saw when it took 4 or 5 years to get that account back to even. So here's the math. Because what we do is we go, well, if the account's down 10%, then I only need 10% to get back to even. And at that point, that's true. But notice how it becomes exponentially, the difference becomes exponentially larger because it's a deeper hole. So, the math doesn't work out so well. So here we have the math for you. And I worked with Daniel to make sure I got the math right. Thankfully, his skills have rubbed off on me enough. So he says, yeah, I think you're in the ballpark here. That's close enough. All right, so if we have a loss of 10%, we need a gain of what? 11%? That's probably possible. If it's 20%, it's 25%. Now, this is kind of our threshold. We like looking at it from that standpoint because you think of it as odds. If we're off 20%, now we know we need a gain of 25%. That might happen. But now notice what happens as the loss number gets larger. When we go to 30%, this is illogical. Now we need a 50% gain just to get back to even. And when we go to 40%, we see that it's now over a 66% gain just to get back to even. When we get to 50% loss, that's 100%. And let's pause here. So if you have $1 million and it drops by 50%, that leaves you with 500,000. So people think in terms of, I need 50% to get back to even. Well, 50% of 500,000 is 250. You're still not back to even. So we need 100% of 500,000, another 500,000 to boost the account back to the high of $1 million. Do you like those odds? We do not. So we don't want to play the game in that way where we have to explain that or apologize for it, particularly when you are taking withdrawals for any reason whatsoever, whether they're required minimum distributions imposed by the IRS that you must take increasing withdrawals. Once you start taking your distributions, now it's 72 for the rest of your life. I mean, the math is, I think it's a withdrawal rate at 72 at 3.67% of the previous year's market value. Stick around 95, and now it's 11%. So you can see if you have, any combination that might, for example, present you with a modest withdrawal of 3% and a 57% market loss, that's now a drawdown of a total of 60%. What do we need as the gain to get back to even? Here we go. It's a whopping 150%. Again, do you like those odds? And again, please notice how the gain it gets so much larger to offset the loss. It's just not logical that you would need that kind of gain, but that's why we do the math. So again, we want you to determine which one of those numbers, if these are the 6 that you were choosing from, work for you. We're not trying to tell you what that number needs to be. We're asking you, and in fact, we'll send this to you when we're done, so that you have a chance to figure out what kind of loss can you live with, because we think that is just crucial. And that's part and parcel of the work that we do, which is very different than our peers, where effectively we have nothing for you. We're pretty flat-footed. We don't know what to do. All we can say, well, that's the market. Do you have any more money? And as I say to you, our clients look at that and feel like they've just been insulted, and I can't disagree with them. So if you want help in this regard, this is what we do. And now let's look at what we think might happen. This is the best example I could find. And by the way, this is in the Times Magazine article that just came out yesterday, all right? We were able to get an advanced copy, but you've been hearing about, I said to you that there was a V-shaped recovery with the stock market, but not in the economy. And what I've suggested that it might be an L-shaped. General Patton, I think it was his best line is, if everyone is thinking alike, then someone isn't thinking. I think that's true, all right? So we want to look at it from the standpoint of what else might be on the horizon, as opposed to saying, well, everything's just going to be fine. We can go back to sleep and just do everything we used to do. And then, as I say, it's the bus you did not see, you did not name, and you could not foresee showing up in your face. And if you're lucky, you get to pull yourself up off of the pavement and get the license number and hopefully survive. So this is what's showing here is a jagged swoosh recovery. And I thought the description was spot on. It might be U-shaped for the next year or so, and then pretty jagged after we get through 2021 moving forward. And keep in mind, everybody wants to get out and spin, and I think that will happen in some areas, not in others. At the same time, it's worthy of keeping in mind that globally, we have more people aged 65 and older than 5 and younger. That we've never been here before. And by the way, with COVID, I was just looking at this yesterday. It looks like a year from now, we may have in the United States of America 300,000 to 500,000 less births than we did a year ago, because it looks like condom sales are pretty strong, but the desire to have babies these days is pretty weak. That's just not happening in the US. It's worldwide. It's not just because of COVID. It's because of a host of things, but I'm just hoping you can see that while so many of us want to get things back the way they were, in many cases, it's just not going to be like it was before. So hopefully there will be a vaccine. You'll see a lot of updates when we get that kind of encouraging news, but it is news. It's not fact yet. In the event that we get some negative news, that's what we're very concerned about. And we look at, this COVID-19 is certainly a severe crisis for the real economy. That's Main Street, not Wall Street. So be careful of the leaders you listen to, because many of our leaders, we know what they want to do. Say, don't look behind the curtain. There's no man behind the curtain. And just wear your rose-colored glasses. Drink all the Kool-Aid. We do not drink the Kool-Aid here. We do not wear rose-colored glasses. And I come from a fine family of Pollyannas, as Daniel can explain to you. But what I'm saying to you is not about being pessimistic. It's not about being optimistic. It's about being realistic. Let's look at it the way it is, and more importantly, determine how you want to play the game, as opposed to, hoping for the best. We'd rather hope for the best and plan for the worst than the other side of that equation. All right, so let's take our subject and look at, the first part of what we do is planning your financial success. So we want you to know how much money you're going to need behind door number one at your retirement age, so that you can see the equivalent of what you're earning in $2,020. And that way, now we have to try and live off that money for the next 20, 30 years. But for example, we talked about a case here where we have two folks like mid-30s making $100,000, and their goal is to have the same equivalent income in 35 years at age 70, which means their goal is now $2.6 million. For the first time, they see the goal. And for them to reach the goal, what it requires is setting aside 15%, $15,000 of their earnings of $100,000 gross earnings every year, getting like a 7% return. And with that combination, they'll be on track for 2.6. Now, it won't be perfect, but it's like getting on an airplane. It never arrives exactly on time, but you got there safely and you got to the right airport. So we want you to see what is your target and see what you can do to get there on time safely. And then make sure we're reviewing the data and the changes so that you can see, do we need to increase the contributions? Did the returns not average 7? Did we get better? Did we get worse? What adjustments need to be made so, as I say, we can get to where we want to be on time and safely. But the other side of that equation is, on the one hand, we want to plan as if you live too long. On the other hand, we have to look at it in the event you die too soon. I mean, we're talking about things that happen in life, and I think it's true. Mother Nature and Father Time hold the true trump cards, okay? So let me start it this way, and then I'm going to ask Daniel and Scott to pitch in. Scott Zimmerman is here. He's going to talk about life insurance. We want to look at the types and why you need what you might need. But let me present this case to you first. You know of so many people, it might have been you, where you spend all this time in a divorce and all this money making sure that so-and-so is going to pay me for the rest of my life. And every time I'm in those conversations, I go, well, you're used to $80,000 a year. And, that so-and-so had the nerve to treat you wrong. And now you're on track to receive $80,000 a year from that so-and-so. Here's my question. Suppose that so-and-so dies after you received your first paycheck. What recourse do you have? And I actually talk this way with my colleagues, the family law attorneys, kind of a nice title, right? And to say, you guys spend so much time about the alimony and the child support. You spend no time helping the survivor discover if the person's supposed to be sending you your client $80,000 a year. If they die, you spend no time helping that survivor see that person needed $2 million on the deceased, so that maybe their return is 5, 6, 7%, but the withdrawal is 4%. That would give that person who survived that event the cold hard comfort of knowing I may or may not miss that person's $80,000, but I'm not going to miss a dime of what they used to send me. This is so important. So this is a conversation we want to make sure you are having with those folks you know who are going through a divorce, or those folks who are going to be going through a divorce. Don't just argue over, the sustenance from the standpoint of the child support and the splitting of the assets and the lifetime support. If that person dies, you're done, and they might be laughing all the way to heaven. So Daniel, give us an idea. This, I think, kind of helps paint the picture, but let's look at it a little further in terms of when we're doing planning and we're looking at the life insurance for a couple, for example, how we help each potential survivor see what it takes so that that survivor financially it's a non-event.
So we're going to look at a quick example here, which is pretty common. Younger couple with a couple of kids making 100,000 a year. When we're talking to them, the first question we need to figure out is, do they actually need insurance? And Scott's going to go over that in much more detail. But the question we need to ask is, are you interdependent on each other's income? If the answer is yes, then for sure we need insurance. Then the second question is, how do we figure out how much insurance is needed? There are essentially two ways we look at spending insurance proceeds when the death occurs. You can either take the proceeds and spend down debt like credit card or the house, and then the survivor lives on whatever's left in their income. Or the second way, which is something we prefer, is to look at replacing income. So in this scenario, she makes 60,000 and he makes 40,000, and God forbid one of them passes away. The question is, how much insurance do we need in order to replace the other person's income?
And by the way, this is when we say we're using married couple, we really mean couple. If there are two breadwinners, what happens to the survivor if the other breadwinner dies? So nobody needs to be married is what I'm trying to say. You're interdependent upon each other's income. How do you make sure you can stay independent and living the life that the two of you have put together?
In this scenario, he needs 1.5 million on her life, and she needs 1 million on his life. With those insurance policies, we know that God forbid something happens to one of them, we can reproduce the income that's going to be lost. And financially, it's a non-event. Going to miss them emotionally, but financially, they're whole.
This is so important, and we can't stress it enough. And so many times the guys come home and say, I'm worth more dead than alive. I've got, $500,000 worth of group, ha, ha, ha. And the wife buys it. Well, to Daniel's point, think of it this way. Let's say it's 50,000, just to make the numbers really easy. And now you have, a check for 500,000 at $50,000 a year. If you're spending that in 10 years, what do you have? Zero. If you're taking the 4% withdrawal rule, which is what we often like to apply, 4% on 500,000 is $20,000 a year. You were used to 50. Now you're getting used to only 20,000. What's going to make up the difference? But we want you to see this in advance so that you're not having to sell the house or move to, I don't know where, the South, right? Where everything's so much cheaper, and just disrupt all the life that you enjoy wherever you want to enjoy it because the money, the person died and took all the money away. So Scott Zimmerman has been a life insurance professional, I believe, since 1989. So that's 31 years or so. He just got back from surviving a trip with his daughter, went to Chicago and then to Boulder to take her to college. He does a lot of succession planning and will help us now that we get a sense for how much insurance we have. We want to look at what kind of insurance there might be. And please, as I say, when I say I apologize for my insurance professionals, we're also insurance licensed. Typically, the bad question we ask people is, what's your budget for insurance? I mean, that's like say, what's your budget for car insurance? It doesn't work that way. With this car, that zip code, and your driving history, this is what you're going to pay. Otherwise, you're self-insured. So Scott Zimmerman, please take it from there and help us see, now that we get a sense for how to do the math, what style do we have from what kind of policies serve what purpose?
All right, thank you, John. Daniel, thanks for having me. Just a little bit about myself. My name is Scott Zimmerman. John mentioned it was my 31st year. I started in 1989. I'm a junior compared to John. 1979. I mean, he's amazing. Our company is called CorpStrat, and we specialize in a few things. The company specializes in employee benefits, HR, and payroll for small to mid-sized firms. With my specialty in the firm, I'm a partner. I specialize in the life insurance, the long-term care, and disability insurance. Yes, so let's get started. So looking at life insurance, we're going to go over seven 7 things that people usually look at when they're buying life insurance. There's a lot more. We could probably talk, John and I could probably talk about 100 reasons to buy life insurance. But the first one, the reason why people usually buy life insurance is they have people to take care of. They're married, they have children, they may have an aging parent. And like John said, how much, there's a way to figure out how much you need, which is the most important part, not just buying a round number. But I look at life insurance as love insurance. If you love somebody, you usually want to take care of them. And some people just want to cover the minimum, and some people want to make sure they really take care of their loved ones. But that's what life insurance really is. And we're going to get into the different kinds. And a lot of people say, what's the best kind to have? We'll get into that later. But in my opinion, the best kind to have is the kind that's going to be there when you need it most. We'll talk about it in a little bit. But, we mentioned aging parent here. There's a lot of people that take care of their aging parents financially, doing things for them. And they don't think about getting life insurance to cover themselves, to help take care of their parents. God forbid something happens to them or something happens to their parents. So it's something really important we'd like to talk about. The second reason why people buy life insurance is to pay off debt. And we see this a lot. People either want to use life insurance to replace an income or pay off debt. People look at life insurance different ways. But a lot of people will say, I own a home, I have a car, I want to make sure my kids' college is taken care of. That's how they buy it. It's to pay off everything to leave their family, they think, debt-free. It doesn't take care of the income part, that John mentioned, which I think him and I both feel is one of the most important reasons to use life insurance. Next slide. Okay. John mentioned this, support spouse payments, alimony, make sure child support is taken care of. A lot of good attorneys, divorce attorneys, will put that in the divorce papers saying, I want to make sure the person receiving alimony and child support is taken care of, God forbid something happens. But I see it more often than not that the attorney doesn't put that in. And we do feel that's really important, because things do happen in life. They do happen. The ex-spouse who's ever receiving the benefits, or the children, can be greatly affected if they don't have life insurance. Fourth thing to talk about is a special needs child, or even a special needs adult. That's common, and a lot of parents that have a special needs child or a special needs adult, they take care of. They're in their home, they're taking care of them financially. Imagine if something were to happen to you, the parent, this child can be left in basically la-la land. What you really want, what a parent with a special needs child or adult really should be doing is getting a life insurance policy, but on top of that, setting up what's called a special needs trust. And the trust is designed by an attorney, an attorney that does a special needs trust, take care of that child the way the child should be taken care of if something were to happen to you. John, jump in if you want to jump in on anything. I'm just kind of going through everything.
You're doing great.
Okay. Next slide is it's another reason why people buy life insurance is co-signed debt. And we see this with a lot of business owners. A business owner will buy a building, a large piece of equipment, expensive piece of equipment, and a lot of the banks are requiring life insurance to protect that loan. A lot of people will buy a new policy to take care of that loan if they don't have insurance. But some people that already have life insurance, you could do something called a collateral assignment. And you can assign a portion of that death benefit to the bank so that God forbid something happens, the bank's taken care of. Number 6 is life insurance is used to create inheritance. I mean, this is a big one. Some people, like John said, hey, I got $500,000, my family's taking care of it. Some people jokingly say, they'll figure it out when I'm gone, but I think really most people, they really do want to take care of their loved ones. Life insurance can be amazing. One of the best vehicles to create an inheritance, a legacy, leaving money to their children, grandchildren, etc.
Yeah, I'll chime in here, Scott, that I love this line. It's the only way to create an estate with the stroke of a pen. That's what life insurance can do. And one of the ways in terms of inheritance, it can be what's called a second to die policy. In other words, maybe the first person, mom or dad, dies and then the survivor doesn't need any money. But the purpose is to get the money to the kids after second death. Okay, so it's a second to die policy. The beauty of that one is it's one policy on two lives, and now you have probably a pretty significant reduction as far as cost is concerned, because we have a female involved. Usually, of course, females live longer, and so it's a way, if you're interested in setting aside money without setting aside assets, as I say, with the stroke of a pen and one in policy, at second death, it now pays off the exact amount you want to give to each child, and it's by beneficiary designation. So it's very clear. Here's the death certificate. This was supposed to get this much, or as a percentage. It's very clear, and you want to make it very clear.
Yeah, that is a really good point. Another good point to that, it's a great point, John, is setting up a trust. Also, it's designed, you can design it so the whoever's inheriting the life insurance proceeds, it can be set up so the money's delivered exactly when and how often you'd like it. For instance, I mean, imagine, like, I got a 21-year-old, and John was mentioning, I just drove her to Chicago, so I wanted to move there. But imagine her receiving millions of dollars from my life insurance. Look, I'm a life insurance guy. We have too much life insurance. We have a lot. But imagine her, 21 years old, receiving millions of dollars. What's she going to do with it, right? So setting up a trust, you can have the money go out at certain times, at certain ages, except you fully decide how you want that money delivered.
And so is a conversation. It's so fascinating that in this country, we spend so little time talking about money. If you're rich, you must be a crook. If you're poor, you must be an idiot. I mean, that's about the extent of it. But we need to sit down as families, particularly while we have the time and there's not a whole bunch to do. What do you want me to do with this that you're giving me? And the other part of it is sometimes we'll see folks, Daniel and I don't know how many times, well, I want this one to have this house, that one to have that house, this one to have that. And I have to say to them, I'm speaking on behalf of your children. They don't want your stuff. They're going to be too polite and not tell you what I'm telling you. I don't have to be too polite, but let me tell you, this is how they think. They'll take cash. Clearly, they want cash. Stuff, even houses, that's your stuff. You do with it what you want. So let's have a conversation about who's supposed to do what with this money, or at least what you learn to accumulate what you've achieved, so that they develop some habits. And now you have a conversation that you've never had before, and an ongoing one about what each of you are learning or you're seeing, and how you're playing the money game, if you win, if you will. But that becomes more interesting than just talking about, well, politics and the weather.
Next slide. The seventh reason that we're showing is a reason to people buy life insurance. It's to pay for a funeral. It's not just about the money, but it also, a funeral can cost anywhere between $10,000 on the low end, all the way on up. The average that we see is $25,000. But it takes care of, if you don't have a lot of assets, your children will get this money to pay for the funeral very correctly. And it's a really inexpensive item, and it's a peace of mind for you and your children to have. You know, just to name a couple more, John, reasons why people buy life insurance: buy self-planning. If you're a business owner, and I mean, this is really important. If you're a business owner and you have a partner, you really want to have insurance on each other. If something were to happen to one of the other partners, a lot of times it results in a disaster. For instance, if John and I were business partners, and our business was worth $2 million, and we both had $1 million of insurance on each other, and something happened to me, you get $1 million to buy my share of the business from my spouse. So he owns it out. He doesn't have the insurance. It's going to be to sell the company, or he's going to have to keep my wife on as his partner. But to make it even worse, my wife, her new husband's his partner. So you really want to not only have the insurance to take care of each other, you want to set up something called a buy-sell agreement between an attorney. It just really takes care of peace of mind and that something would happen to each other. And another thing, John, you may want to touch base on this, is estate planning. You know, the rules today are high, and they're going to be going lower. But If you're single, you can pass on approximately $11 million tax-free to your heirs. Everything that after that is taxed about 40%. So a lot of wealthy people buy life insurance to take care of that estate tax. If you're married, it's $22 million. Just pay on the second death, $22 million to go estate tax-free to your beneficiaries, but anything over will be taxed at 40%. It's in 2026, that's supposed to be going down. It could come down sooner. They're questioning that on the elections, what's going to happen, but 2026, it's stated it's supposed to be around $5 million a person that's going to be able to transfer tax-free to your beneficiaries.
I wouldn't be surprised to see that level come down because clearly the governments, small, large, local, national, they're just not getting enough cash. So if I were a legislator, I'd go, yep, sorry, we're going to have to adjust this. But we need more cash to keep your streets the way you want them to be kept.
Right. Next slide. A really important thing to know, and you're probably all aware of this, but life insurance proceeds are tax-free. Whoever receives a life insurance money does come out tax-free. So here's 5 common reasons why people may not want to buy life insurance. One is I'm too old or I'm too young. The older we are, the more expensive it is. Sometimes it's not really affordable. And when you're too young, there's not really a reason to have it. Number 2, you don't have any children or you don't have anybody depending on you. Sometimes there's not a reason really to have life insurance. Third one is my health isn't great. The healthier you are, the less expensive your policies are. If you're unhealthy, a lot of companies will decline coverage and not insure you. If they do offer, if you're really unhealthy, they do offer insurance. They do offer the insurance. It's super expensive. You don't work outside the home. Okay. Notice come up. You don't work outside the home. You may be a at-home spouse who doesn't work, and maybe if something happened to you, financially you're not going to affect the family. And there's not enough time to get coverage. We've gotten calls over the years of people that are going to travel outside the country and they need coverage. They want it right away, and it's just not enough time to get it. Getting insurance, applying for coverage does take a little while to get approved. Usually, on average, it's 30 to 60 days for approval. Next slide. So before I get into this policy design, there's 2 different types of, there's 2 different types of life insurance. There's term life insurance, and term life insurance, it's the inexpensive type of life insurance. You can buy it for a certain term. The typical is 10 years, 15, 20, or 30 years. So you're able to buy life insurance and have the rates guaranteed for 10, 15, 20, or 30 years. If you bought a 10-year level term insurance policy, it's a lot less expensive than a 30. Then the 11th year, we decide you want to keep it, the rates skyrocket. Same thing, if you bought a 15-year, the 16th year it goes up. So term insurance, you're buying it for a certain term. It's fairly inexpensive. The other kind of life insurance is permanent life insurance. And permanent life insurance is what it says. It can be permanent all the way to the end, to your time, your death. You could set up policies to go all the way to, believe it or not, age 125. People are living longer than they were before that. Some policies are going to 125. But when you set up these permanent insurance policies, there's so many different kinds. There's universal life, there's equity index life, there's whole life, there's second to die, there's variable life. And there's a big list of them. But designing the right policy to fit your needs is what's really important. There's not one that's right for everybody. In this example, we're just showing a whole life policy for a male 35. It's a whole life insurance policy, that type of permanent insurance. This will go all the way past 95. It goes way past. But this example shows 3 different policies, a whole life policy, the same premium going in each policy. So $12,000 a year. Policy 1 shows how you could design these policies to make it look like what's so important to you. Policy 1 shows almost $700,000 of life insurance with the same $12,000 going into it each year. You can see at age 75, there's $1,358,000 of cash value. So this policy was set up for cash value. Policy 2 is the same whole life policy, but you're bringing the death benefit down as low as possible, really low, $353,000, same premium, but it accumulates more cash. There's more money going towards the investment or the interest that it's earning. You can see that at age 75, that one has $1,579,000. And then policy 3, again, lowering the death benefit, and at age 75, that has $1,646,000. So the bottom line is, when you're looking at permanent life insurance, you can set these policies up, make it look like what you like, what's really important to you. Some people want a permanent life insurance policy where they have the premiums as low as possible. They don't really care about the cash value. They just want to make sure the policy goes to 100 or above. So it's really important to know you can design these policies how you want. A couple of important features on permanent life insurance. Money that's growing inside the policy grows tax deferred. You're not owing any money on this policy as it earns interest. At the same time, you can pull this money out, not all of it at once. There's a way to set it up. You can borrow the money out and get the money out tax-free, not having to pay any taxes on the money. There's more details to that, but it's a really great feature. Next slide. This just shows term versus whole life, or you could actually say permanent life insurance also. But premiums stay the same. Term life insurance, it does stay the same for whatever term amount you buy it for. But a 20-year level term policy, the rates will stay level for 20 years. Whole life stay level forever. The payout death benefit is guaranteed. As long as you're making your premium payments, proceeds are, again, paid out tax-free. Purchase by length of coverage, such as 5 to 30 years. Term life insurance is that. We went over that. You buy it for usually 10 to 30 years. Whole life is forever. Cheapest form of life insurance is term life insurance. It's almost like car insurance. You're paying for car insurance. Hopefully you never get in an accident. If you do, that's what it's there for. There's no bells and whistles. It's strictly a death benefit. It lasts the entire life. A permanent life insurance will last the entire life, where term will not, and build up with cash value. Whole life or permanent life insurance is great options to build significant cash value if set up correctly. So any questions, John? I want to go over one more thing. If you have any questions?
Well, I do want to pick up, I should have finished this point with regards to the insurance for people going through a divorce. And if this is an important piece of the puzzle, when we're working with the client who is talking about that so-and-so, we'll use a him, that so-and-so, he's supposed to pay me $80,000. Daniel and I write the policy so that all he has to do is submit to a physical. That's all he has to do. My real point here is, so many times, maybe the lawyers agreed that this was something that the husband was supposed to do, have a life insurance policy. He produces the policy, but because he's the owner of that policy, you have no control over it, which means that, you're married to me and I show you a $2 million policy and then I cancel it tomorrow. When will you find out? So the point is that if you're the owner and the beneficiary, there's no surprises. You know everything that's going on with that policy. And if that means you have to be the responsible party to pay those premiums, so much the better, because now you know exactly what to do with that birth certificate, as opposed to, oh, I think there's a policy. What's the company? Is there a number? Clearly, they could have died and you not know it. So be the owner and be the primary beneficiary and identify who's next after you, so that there's no confusion, but definitely be the owner. Who owns that policy? This is something that's very important. Look at the beneficiaries on the insurance policies, on everything that's relative to retirement plans, to make sure who you want is next in line. Daniel and I sat down with one lady to help her figure out how to get Wells Fargo to answer her questions. That was unbelievably difficult. That's a whole different story. But when we went to look at her beneficiaries, she asked the question, there's 5 people down there. Who are those people? And I'm like, well, that's my signature next to your signature back in 1982. And I wrote down the names you provided me. and you don't recognize any of these names, so we have to put together a new list, and we did that, and that took a while. But my point is that, you know, in fact, there's one case where Daniel and I studied where this was an educator in New York who got married a little bit later, started work pretty young, made her sister the beneficiary of the insurance policy and the tax sheltered annuity as an employee of a school system. Over $1 million in that account. The wife passed away. All the money went to the sister. None went to the husband. He contested it, but because that's the way it was placed on the original application, there was no contest whatsoever. And the sister said, sorry, son, you're not getting a dime. She wanted me to have it. I'm taking it. Okay. The reason we often write term when we come to you saying, let's look at insurance, is because our intention is to help you become self-insured. In other words, the couple that needs 2.6 million, if they had that today, there'd be no reason for any life insurance, but they don't. So we want to make sure this is a bridge, if you will, to say, let's make sure we make up for the shortfall, and then let's make sure that we're on track to have this amount that you need in 25 years. But then we need to evaluate that as time elapses to make sure maybe we give up the policy. We're not getting any cash value, but we're not paying any premium payments because you are effectively self-insured. And the point that Scott made I want to underscore is the kind of a beauty of permanent policies is the ability for those who are really well off to stash them with cash, because it's a beautiful way to be able to borrow money out of that policy that you can't do in anything else. Now, we're not suggesting that is the way to go. What we are suggesting is we've seen that be a very good tool for people who are very flush with cash, and they can put a lot of money into a place that they don't intend to have any benefit from it, but be able to know that they can, at their discretion, take money out and effectively borrow against it, no taxes. They can be a very beautiful way to build up a whole lot of cash value and a whole lot of income. Okay, so I think I covered what I was supposed to cover, Scott.
Right.
Are we ready for Q?
Yeah, just really two more quick things. I love what you mentioned on the looking at the beneficiaries. It's so important. I totally agree with you. It's just so many mistakes. But two things I want to mention really quick is it's never been easier to qualify for life insurance. It used to be, to get a $25,000 policy, you had to do a blood test and go through the whole underwriting process. Now you can get up to $5 million in some companies without even an exam if you qualify. And lastly, I just want to mention the
up to what age, Scott? Up to 5 million?
Different companies, usually age 60 is the cutoff to get, if they'll do no exam, but if they do an insurance phone interview, if they ask you a question, you're on a medication, had some health issues, they have the right to ask for an exam. But we're getting through about 60% without an exam, which is pretty. Last thing I want to mention, which I think is super important, we've seen this over the last 5 years, older policies that are not looked at. We recommend highly anybody that has a policy, they do a life insurance audit, especially on permanent life insurance, because certain life insurance companies were showing interest rates that they were claiming to pay off an illustration, and they've lowered those interest rates they're paying. They've raised mortality expenses in these policies that people have been paying for without looking at their annual statements. They're paying for it yearly, and they think the policies will be there when they need it. They're falling apart. So by doing a life insurance audit, you can make sure your policy is safe. You can see if it's not strong, you just may have to add a little bit more premium to make it last longer, to make it safe. I actually think it's super important. We've seen a lot of issues over the years, a lot.
Okay.
So, yeah,
nice. Beautiful. Appreciate it, Scott.
Thank you.
All right. Daniel, what questions for who?
Okay, we're going to open up for questions. On your menu bar, there is a Q&A button. You can ask a question through there or send me a chat directly. First question for you, Scott. My wife is 77 years old and I'm 80. She has a $50,000 whole life policy with cash value of $43,000. If we cash it in, do we get the entire amount? Do we have to pay income taxes? And are there any penalties involved?
Okay, great question. There is no penalties. What would happen is if you were to pull out the $43,000, only tax you'd have to pay is on the gain. So anything you put in, you get out tax-free. Everything above it has to pay taxes on.
Excellent. Next question for you, John. How will the election affect the stock market?
Well, the good news is that there doesn't seem to be much difference in terms of advantage, whether it's Democrat or Republican. But if we really look at it more closely, we do see that contrary to most people's expectations, the market seems to do better under a Democratic administration than it does under a Republican administration. So that's one of the reasons we really like looking at things, because we have a way of thinking about it and it's logical. The Republicans are known to be more business oriented, so the market must do better. But that is not the case.
Next question for you, for both of you, I guess. How do you determine how long you need life insurance for? And Scott, we'll start with you.
I think John has something to say, but I think people look at it different ways. I write a lot of it. People have different ideas. People will say, well, I just want to have enough insurance to get my kids through college. So they'll add on X amount of years to make sure their family's taken care of. I always recommend do it as long as possible, because you can always cancel if you buy a term life insurance. You can cancel anytime. So that's one option. But John, I knew you were going to say something, so I didn't want to.
Well, what we would ask is, what's the purpose? Because what often happens, like I'm really high on this complacency thing. So many times we get into the pattern and we never look at what the heck am I doing here? We just keep doing it over and over again. What the heck? I can afford it. Who cares? But maybe there's to the question that was just posed. What else would you like to do with this money? It's sitting there. Do you want to use it? Do you want to die with it? What is your purpose? And that's why for us it's so important to assign the value that we're trying to derive from the policy so that it serves a specific purpose. And if that purpose is no longer needed, I don't see any reason to continue holding the policy or keep the cash value there. I'm sorry, if I'm 81 and 77, take the money and run. You've got enough assets, I would imagine, and $45,000 might be meaningful to you right here, right now, as opposed to saving it for those folks who are going to say, thank you, but I really would like for you to enjoy it. So let's look at the purpose and answer the question from that perspective, as opposed to just doing the same old, same old.
Okay, next question for you, Scott. I'm employed and have life insurance through my employer. What will happen if I retire?
So there's I would say most companies are offering having life insurance through their employer. Most of them, when you retire, it goes away. There are some companies that offer they let you it's portable, so you can take it when you retire and start making your payments yourself. So it really all matters how it's set up, and the insurance company, what plan you're with. So I'd like to give you a direct answer, but I can't. It's usually one of those. It's either going to go away when you retire, or they're going to offer it to you when you retire to take the payments away.
Yeah, we like to treat group insurance as icing on the cake. So if I have $500,000 worth of group, I would not count that. I mean, I would certainly, I want my beneficiaries to receive it. But if it is the case that, my spouse needs $80,000 a year, I need $2 million on my life today. And by the way, that's what I have had when the children were, up until the time the kids were grown. So and the instructions were, you're going to 4% on 2 million. This is 80,000. But the group, you don't want to have to go to another company and then recognize that what was free for 500,000. Now in fact, we were just talking to a firefighter. We're checking this, but it looks like he discovered, because he hadn't looked at this before. Surprise, surprise. This firefighter, it looks like there may be only $50,000 of life insurance provided by the fire department. Well, that's woefully insufficient.
Sure.
Okay, when people are making over $100,000 a year as firefighters, and we have someone who is working. And by the way, let's talk about that for a minute, because when people say, well, I'm not working, so there doesn't need to be the insurance on me. If I'm not working because I'm taking care of the kids and I die, and now you have the kids, what the heck are you going to do with them? Do you need? some money to put them in school or to get them dressed or get them back and forth to school. So there may very well need to be, let's say, as little as $1 million on me, so that you know that that's a 4% withdrawal of $1 million, that's $40,000 a year. Now you can write checks and keep doing what it is you do, and the kids are taken care of, because that person who didn't work for a living certainly contributed a whole lot to the bottom line, even though it wasn't dollars.
Excellent. Well, last question, and we'll start wrapping up. If you're 55 years old, is it better at this stage in life to buy more term insurance or whole life insurance?
Want to go, John, or you want me to go?
You can start. I'll see if you finish.
Okay. Yeah, in my opinion, is how long do you need that insurance for? I would ask that because the term is going to be less expensive than a permanent insurance policy. And how long do you need it for? And what is the goal with the insurance? Is it just to have it at the end, or is it to accumulate cash value? So you want to look at maybe both options. John?
Well, yeah, and I would say, what does your age have to do with it? Again, what's the purpose? 25, 75. What's the purpose? 55. Well, that's not the driver. What would you want this money to do? That's the first question. And then the second part is, do you think is it a permanent situation that you're trying to cover, or a temporary situation? That'd be the second question. But I really don't think age is the driver here. It's not a determining factor.
Usually for us, insurance is part of a whole financial plan, so it's only a part of the question. Oftentimes, insurance is a bridge between working and retirement, because if you're doing everything else correctly, then once you get to that retirement age or that work optional age, your assets will simply take over the funding for your lifestyle, and insurance isn't needed because you're self-insured. If you know you need $5 million by the time you're age 65 and you have $5 million somewhere, then the insurance is very optional and you can let it go. If you're not doing those things correctly, that's what insurance is needed for a premature death. All right.
Yeah.
So we're going to, sorry, go ahead.
No, that's good. You're right.
Excellent. So we're going to share one additional thing with you. We have these new beautiful insurance calculators that we just got approved. We have one for retirement and one for insurance that will help you determine how much insurance you might need and what your retirement number is. We'll be sending this out with our follow-up email today.
Please feel free to use these. They're, as we say, brand new. Share them, particularly with your children, nieces, nephews. We want to have more conversations with people making intelligent decisions about what is it you're trying to do here and how might it work for you. And it's a personal answer. But as long as we stay unconscious, we never get around to asking the question, let alone answering the question or figuring out, what is my correct answer as opposed to what somebody else's answer might be. So speaking of preparation, and please notice our trademark is the proof is in the planning, and we're very proud of that. You may need an attorney that you don't know you need one now yet, but you could need one in the future. So we're going to be outlining by working with an attorney to share his ideas as far as, what kind of situations, like maybe you don't have to worry about a DUI, but your grandson sure does. And maybe you need, the attorney on tap, so that in the event that someone has to go to court on behalf of your grandson or whatever the situation might be, it could be a real estate issue. It could be a COVID issue. But there are times where we would certainly want you to have a relationship with an attorney so that you can turn to someone you trust, you already know them, as opposed to scampering for what do I do now that I may have to file a lawsuit? How might I work with someone who's going to make sure, for example, that the insurance for the water damage in Daniel's house is going to be fully covered, and they're not going to, the insurance company is not going to require Daniel and Millie to, live with this kind of a washer dryer as opposed to that one, which isn't up to standard relative to what they used to have. You understand what I'm saying? So we'll be talking about that just next week. So please join us. All right, so we're looking at unprecedented times. I think it's a common word. It explains a whole lot of things. And we're saying if you found that it was kind of surprising what has happened this year so far, really, you're probably not well prepared for the next 20 years. And that's the work we like to do. Again, the proof is in the planning. And as I say, it's not about the prediction, it's all about the preparation. So how can we prepare for the good, the bad, and the unforeseen? We don't have to predict the future to be better prepared for the future, including the unknowns. And part of this, as I say, is understanding how you might be able to limit the loss as opposed to just ride the roller coaster, and recognizing that if it is 2.6, how can I keep my balance within my parameters, win, loss, as opposed to watching 2.6 drop to 1.3. And now to get the same income at that time, we have to double the withdrawal rate to derive the same income. That's a terrible 1-2 punch in terms of this plane absolutely is coming down out of the sky, and it's going to land hard, and it probably won't be on tarmac. So if there's a way that we can help you, please let us know what that is. And please know that we are working with people who are frontline workers at no cost to put together financial plans. It's our sincere way of saying thank you. You know, we've got your back. Thank you for putting your lives on the line every single day to keep us on this side of the grass. And here's how we can return the favor to you so that you too can see that you can afford to stick around and have something to look forward to and something to live for, as opposed to bringing home the COVID to your family and, you know, things do not end up well there for you. So that's part of what we do, and that is without cost or obligation. When planners do plan, put financial plans in order, we find that the average cost tends to be about $2,000 to put a proper plan in order. We'll spend up to 90 minutes on Zoom with the couple and help them walk through all the things we just walked through, in addition to planning for the children along with their financial plan, so that they can see what it takes to make work optional on their time frame with the kind of income that they want to have at that particular time. So with that, we will say thank you again. Your feedback is appreciated. This is something we enjoy doing, and part of the reason we do it is because of your feedback and because we recognize that our colleagues aren't doing anything like this. So we enjoy doing those things which are different and we think are valuable. Please stay safe. Please wear a mask. Please social distance. There's enough drama going on right now, and we need all of you, all right? So please stick around. I look forward to seeing you next week, and let's all stay on this side of the grass.